Look around you right now. You see walls, desks, and cars. But the real economic giant is hiding in your closet. It is not cotton or wool. It is polyester, a synthetic force conquering the world. This plastic thread weaves a market worth over $77 billion. Analysts predict it will skyrocket to $160 billion by 2032. That is not just growth, that is dominance. Today, 65% of all global clothing is made from this fossil fuel derivative. Consumers call it fashion. Wall Street calls it refined oil. Consider the scale of this dependency. If the supply chain breaks, the world does not just get naked. The entire global apparel economy halts instantly. We are not talking about a simple textile trend. We are analyzing a commodity that is too big to fail. It flows through every mall and online store in America. Yet few investors understand the risk ticking inside. This is the story of the invisible giant. And it starts with a molecule that changed everything. Travel back to the 1940s. The world was at war and needed new materials. Scientists were not looking for cheaper shirts. They were hunting for strategic military assets. In this chaos, British chemists cracked a secret code. They invented polyethylene terephthalate, or PET. But the real wealth came from who owned it. DuPont saw the potential and bought the rights. This was not just science. It was a business masterclass. They secured a legal monopoly through ironclad patents. Every yard of fabric spun paid them a royalty. This intellectual property became an economic moat. Competitors could not touch them for decades. They owned the molecule itself. It allowed them to extract rent from the global economy. This is the power of a patent monopoly. It turned a chemical formula into a money printer. DuPont did not just sell product. They sold the rights to the modern world's fabric. But patents eventually expire, changing the game forever. Let's strip away the marketing labels. Your favorite gym shirt is essentially spun crude oil. This creates a direct link to the energy markets. When the price of a barrel of oil drops, clothing gets cheaper. This is the financial concept of commodity correlation. In 2020, oil prices crashed historically. Polyester production costs plummeted alongside them. This correlation fuels the fast fashion business model. It explains why a t-shirt can cost less than a coffee. But this cheap input comes with hidden volatility. The fashion industry is now tethered to energy shocks. A war in an oil-rich nation hits the clothing rack. Investors must watch Brent crude to predict retail margins. It is a dangerous dance with a volatile commodity. Low costs of goods sold drive massive profits today. But what happens when the oil spigot tightens? The era of cheap plastic clothes hangs in the balance. We are wearing the output of refineries. This liquid gold transformed into solid profit. And it paved the way for a faster, greedier model. Speed is the new currency of wealth. Cotton is biological, seasonal, and slow to grow. Polyester is chemical, instant, and scalable on demand. Brands like Zara and Shine weaponize this difference. They slash supply chains from 6 months to 2 weeks. This acceleration supercharged their inventory turnover. They sell out and restock before competitors even design. This drastically increases their return on invested capital. Shine turns inventory over every 30 days. The industry average lags behind at 150 days. This is the cash conversion cycle on steroids. They do not need to predict the future of fashion. They manufacture it in real time using data. The secret is not selling more clothes per person. It is selling the same person more often. Polyester's speed enables this addiction. It allows for a disposable culture of consumption. Profit is generated by velocity, not quality. But this speed creates a massive pile of waste. And the bill for this excess is finally coming due. The party is over and the lights are turning on. Financial markets ignored the waste for decades. Now, the externalities are surfacing as liability. We are facing a massive microplastic bubble. Washing clothes releases tons of plastic into oceans. Regulators are sharpening their knives in Brussels. The EU is rolling out strict textile mandates. Carbon taxes threaten to crush thin profit margins. This is the bear case for traditional textile stocks. Companies refusing to adapt face existential risk. Just look at what happened to the asbestos industry, or the reckoning that hit big tobacco companies. Polyester producers are staring down a similar barrel. Liability claims could wipe out years of earnings. The cost of doing business is rising fast. Environmental impact is no longer just PR. It is a line item on the balance sheet. Smart money is already exiting the old guard. They see the regulatory storm gathering on the horizon. But in every crisis, there is a new opportunity. Chaos always creates new billionaires. The old polyester model is dying. A green gold rush is beginning to take its place. Venture capital is flooding into textile innovation. The goal is circularity, not just sustainability. Textile-to-textile recycling is the new frontier. Startups like Sire are raising millions to scale. They turn old clothes into new fibers without oil. This breaks the link to volatile energy markets. Biosynthetics offer another path to massive wealth. Imagine growing performance fabrics from bacteria. This is where the smart money is positioning now. They are betting on the transition to a circular economy. The winners will own the technology, not the oil. We are witnessing a historic asset class shift. Your wardrobe is becoming a resource bank. Do not just look at the clothes on your back. See the asset allocation logic behind them. Master the logic, and you will own the ledger. Welcome to the future of wealth.